Hello and welcome students. In the last video lecture I had completed chapter number 4, that is journal. Now in this video lecture I am going to start chapter number 5 of accountancy, that is accounting equation and business transaction. Now students, in the last previous chapters we have already understood the rules of debit and credit of the three different types of accounts, that is real account, personal account and nominal account. And on that basis we have also understood how to write the journal entries of any particular transaction. Now in this chapter we are going to understand the accounting equation that is based on one particular equation, that is assets is equal to capital plus liabilities. Now students, after any of the businessman has to prepare the final accounts at the end of the accounting year in order to know the financial position of the business. Now while preparing the final accounts of any of the business unit, basically three different things are to be prepared, that is trading account, profit and loss account, and the third one, that is balance sheet. Balance sheet is a statement. Students mind well, balance sheet is a statement. All these three different specimens, how to post and related concerned entries to trading account, P&L account, that will understand in the second part of your textbook of accounts. There is one chapter related to final accounts of sole proprietorship firm. At present you have to just understand that for preparing the final accounts, basically three different things are to be prepared, that is trading account, profit and loss account and balance sheet. Now in case of balance sheet, there are two different sides. The left hand side, that is called the liabilities, and the right hand side, that is called the assets. Okay, capital or liabilities. Left hand side is called capital or liabilities and the right hand side is called asset side. Now always the balance sheet should get tallied. It means the total of capital and liabilities should be equal to the total of assets. Then and then only we can say that the accounting or the final accounts entries are correct. Okay. So over here, based on that knowledge or based on that concept of balance sheet, this equation has been developed. That is, assets is equal to capital plus liabilities. It means assets will always be equal to the total amount of capital and liabilities of the business unit. In short, it is written A is equal to C plus L. It means due to increase or decrease of any of the asset, there may be increase or decrease in the capital or the liabilities. It means the effect of one side, left hand side, would be having the effect on the other side, that is the right hand side. Either capital or liabilities will be increased or decreased in accordance with the increase or decrease with the assets. So we will understand this accounting equation with the help of an illustration. This chapter is very small, students. There are only two illustrations and one practical sum in the exercise. So out of that two illustrations, today I will be explaining you illustration number 2 of your textbook, that is totally based on this accounting equation. Okay, so that is on page number 115 of your textbook. Together with that illustration is there, that's why naturally the solution will also be given to you. So while referring the video lecture, you can refer the solution also from the textbook, so that easily you can understand the concept. Okay, now you can see I have written the format over here to write the accounting equation. That is, first one serial number, second one, that is journal entries. Already you are knowing how to write the journal entries of any particular transaction. Thereafter is debit and credit. As per the format of journal entries, debit and credit, both the amount will always be equal. Now effect, it means due to debit effect, what is increased, either assets, capital or liabilities, anything would be increased or decreased. So that effect you have to give of the debit effect and the credit effect. You have to give the explanation of the debit effect and the credit effect. And then afterwards, whether assets, what, because of that transaction, what effect came in the assets, capital and liabilities, that we have to mention of each and every transaction. And at the end of all the transactions, you will get the idea that what amount of assets, capital and liabilities are there in the firm. And we will verify whether the total of assets is equal to capital and liabilities. Okay students, so let's start with the sum. The first transaction, that is Ramesh has brought cash of rupees 20,000 and furniture of rupees 10,000 to commence business. It means cash has been introduced of rupees 20,000 and furniture of rupees 10,000 to commence business. So the journal entry that will come, that is cash account debit 20,000, because cash comes in the business, the owner is bringing the cash to start the business, to commence the business. Then afterwards furniture is also bringing, so assets comes in, so debit what comes in as per the rule of real account. So cash account debit 20,000, furniture account debit, that is 10,000, to capital account credit, that is 30,000. Due to these cash and furniture, the capital of the firm increases. Okay, so what would be the effect of, after writing the journal entry, you have to decide the effect of it. Okay, due to debit effect, cash increases and furniture also increase. Okay, and capital is also increased because capital is always having a credit balance. The owner is bringing cash and furniture in the form of capital. So capital is increased in the firm by rupees 30,000. That is 20 plus 10, total net came to 30,000. Okay, now we have to decide how much assets, capital or liabilities are affected or increased or decreased because of this one particular transaction. You can see assets are written, cash and furniture both are assets. Cash is current asset and furniture is a fixed assets. Okay, so cash is increased by rupees 20,000 and furniture, that is 10,000. So total assets that came to 30,000. Next one, capital is also increased by 30,000. Because of assets increase, capital has also increased. Okay, so capital is increased by rupees 30,000 and no liability is raised. Okay, so liability capital is 0. So for each and every transaction, you have to find out whether the assets or capital or liability has been increased or decreased. Okay, so in the same way, we'll be moving on with the second transaction. Second transaction, that is rupees 5,000 deposited in bank and opened account. It means bank account has been opened by depositing rupees 5,000 in bank. So bank balance will be increased and cash will go out from the firm. So the journal entry that would be bank account debit, that is 5,000, to cash account credit, that is 5,000. Now what would be the effect of this? That is due to bank, we have deposited the cash in bank. So bank balance will increase and cash will decrease from the firm. Okay, now due to cash will decrease, previously the cash balance was 20,000. Now from 20,000, that is we have deposited, DEP means deposited, we have deposited 5,000 cash in the bank. So from the firm, 5,000 cash will be reduced. Okay, so 20,000 minus 5,000, remaining cash balance, that would be 15,000. Then afterwards, bank balance is increased, cash balance will be decreased, but bank balance of the firm, that will be increased. Okay, so bank balance is created of rupees 5,000. Previously there was no any bank balance in first transaction, but because of second transaction, bank balance has been increased by rupees 5,000. Then afterwards, furniture as it is, that is 10,000. It means you have to carry forward of each and every transaction and find out the total number of assets, capital and liabilities of the firm at the end of the particular number of, or at the end of the all the transactions. Okay, so over here cash, that is coming 15,000 after decreasing the balance that we have deposited in the bank. Then afterwards, bank balance is increased by same amount, that is 5,000, and furniture, that is as it is 10,000. So now the total amount of assets, it comes to 30,000, same amount, because cash is reduced, but together with that cash reduction, the bank balance is increased by the same amount. So ultimately the total amount of assets that remains same, that is 30,000. Now capital, there is no any effect in capital, so as it is capital 30,000 and no any liability is raised, so liability would be 0. Okay. Now moving on to the third transaction. Third transaction, that is goods of 8,000 purchased from Rajesh. We have purchased the goods on credit. Over here the name of the person from whom we have purchased the goods, that is mentioned to you. So it is a credit transaction. So the journal entry, you are very much familiar now how to write the journal entry. That is purchase account debit 8,000 to Rajesh account credit, that is 8,000. Now because of purchase of goods, stock will increase. Okay, so debit effect, that would be stock increased, and due to credit effect, liability will increase because now we have to pay this 8,000 to Rajesh, because this is not a cash transaction. In future our liability is to pay rupees 8,000 to Rajesh. Okay, so now we have to find what is changed in the assets or capital or liabilities. Because of stock increase, previously the balance of assets that was 30,000. Now one more asset is increased, that is stock. So 30,000 plus 8,000. So the total amount of assets now becomes 38,000. Capital would be as it is, there is no any effect, that is 30,000. But now liability is increased by rupees 8,000 because liability is to pay to Rajesh. Okay, so in future we have to pay 8,000 rupees to Rajesh. So previously there was no amount of liability, but now the liability of 8,000 is created. Okay, now after completion of the third entry, we are moving on with the fourth transaction. Students, mind well, you have to stick to this format. According to this format only, you have to write the journal entries and mention the amount of assets, capital and liabilities. Fourth transaction, goods of 6,000 purchased for cash. Now this is a cash transaction. Okay, so the journal entry that would come, purchase account, fourth one, purchase account debit to cash account credit, that is 6,000. Okay, now due to purchase, stock will increase. Okay, so you can see the effect, that is stock increase, and it is a cash transaction, so that much amount of cash goes out from the firm, so cash will decrease. Okay, now you can see cash decreases. So previously the cash balance that was 15,000. Okay, so from 15,000 due to purchase in cash, that much amount of cash will go out from the firm, so cash balance will be reduced by rupees 6,000. So 15,000 minus 6,000, the balance, cash balance, that would be 9,000. Then afterwards stock. Stock previously it was 8,000, right? In the last transaction we had purchased the goods on credit worth rupees 8,000. So from 8,000, still more purchase, that is a cash transaction. So addition in stock, that would be 6,000. So 8,000 plus 6,000, it would come to 14,000. Okay. So total now bank balance would be as it is, that is bank balance that would be as it is 5,000, and furniture also, that is 10,000. Again repeating, previously in the second transaction the total of assets that came to 30,000. In that 30,000, in the third transaction we had purchased the goods, so stock increased by 8,000. So total of assets that came to 38,000. Now in this transaction we have purchased the goods for cash. So cash will go out, so cash balance will be reduced. Previously the cash balance that was 15,000. Okay, so 15,000, from that 6,000 will be reduced, so 9,000. Then after stock balance, previously it was 8,000. Last transaction we had purchased goods on credit. In that addition stock, that is by rupees 6,000. So 8,000 plus 6,000, so 14,000. And bank balance, that would be as it is. We have to carry forward all the assets. Students, don't forget to carry forward. If by mistake you forget to write any of the assets from the previous transaction, then the total of assets would not come correct. Okay. So bank balance, that is 5,000, and furniture as it is, that is 10,000. Okay. So the total of assets would remain as it is. See, 9,000 plus 14,000 plus 5,000 and plus 10,000. 10 plus 5, 15. 15 plus 10 plus 5, 15. 15 plus 14, that would come to 29. And 29 plus 9,000 cash total, it would come to 38,000. So we have to give the effect in that particular asset, whether it is increased or decreased, and you have to combine all the assets of all the transactions, and at the end we have to count the total amount of assets, capital and liability. So in this way the total of assets would remain same, that is 38,000 as that was in the third transaction, but over here individual cash is decreased by rupees 6,000 and stock is increased by rupees 6,000. So particular asset is being increased or decreased, but the end the total of assets is equal, that is 38,000. Now capital, there is no any effect in capital, that is as it is 30,000. In liability there is no any effect, so as it is liability of rupees 8,000. So up till now we have completed 4 transactions. Now moving on with the 5th transaction. Now let us read 5th transaction. Moving on to 5th transaction, goods of rupees 5,000 sold for rupees 9,000 to Raman on credit. Goods are actually of 5,000 that are sold at a profit to Raman at rupees 9,000. So profit worth rupees 4,000 that is earned by selling the goods to Raman on credit. Okay, so first of all we have to write the journal entries that you can see on the board, that is 5th entry that I have written. Raman's account debit, that is 9,000, because 5,000 worth of goods that you have sold at rupees 9,000. So actually cash that is listed of rupees 9,000. This is a sales transaction. So Rama, it is a credit sales transaction because still we have not received the amount of selling of the goods to Rama. It is a credit transaction. So So in future he is a debtor, so we have to receive that much amount of rupees 9,000 from Raman. So entry that would be Raman's account debit, that is 9,000, to sales account credit, that is 9,000. We have sold the goods to Raman, so credit what goes out as per the rule of real account. Okay. Now what would be the effect because of this receivable increases? Because in future our debtors would be increased, our receivable will be increased, that we have to collect from Raman. Okay. So debtors would be increased, one kind of assets that is increased, and the second one, that is goods decreased, because we have sold the goods, so that much amount of stock of goods will be reduced from the business. Okay. So you can see the effect that I have written previously in the last fourth transaction, the cash balance that was remaining 9,000. So as it is, because this is not a cash transaction, this is a credit transaction. Okay. Next one, that is stock balance, that was 14,000. From 14,000 we have sold the goods worth rupees 5,000. See, I have subtracted over here, students, 5,000 and not 9,000, because actually the worth of that goods was 5,000 that we had sold for rupees 9,000. So actually the stock of goods is reduced by only rupees 5,000. So here I am subtracting only rupees 5,000. So 14,000 minus 5,000, remaining balance of stock, that is 9,000. Bank balance would be as it is from the last transaction, that is 5,000. Furniture also as it is 10,000, and debtors also as it is from the last previous transaction, that is debtors is increased by rupees 9,000, because over here receivable is increased. So debtors, that is Raman, from Raman we have to collect rupees 9,000. So our debtors has been increased by rupees 9,000. So total value of the assets, that would be 9,000 plus 9,000, that is 18,000. 18,000 plus 5,000, that would be 23,000. 23,000 plus 10,000, that would be 33,000. 33,000 plus 9,000, that would come to total value of assets, that is 42,000. Again repeating, over here receivable increase. Receivable increase means debtors has been increased. In future we have to collect that much amount of cash from Raman, that is 9,000. Okay, so debtors value is increased by rupees 9,000. Furniture was already existing in the previous transaction, that is 10,000. Bank balance also was there, that is 5,000. Stock, that is decreased, because we have sold the goods of rupees 5,000. So stock is decreased by 5,000. So the new value of stock that came to 9,000, and cash value will be as it is, because this is a credit transaction, so there will be no any effect in the cash balance. So cash balance from the previous transaction as it is, that is 9,000. Now total of all this, that is coming to 42,000. And now in capital you can see that previously the capital balance, that was 30,000. In that I have added over here plus profit, because the goods that was worth rupees 5,000 that you have sold for rupees 9,000. So you have sold at profit worth rupees 4,000. So ultimately our capital balance will be increased by the amount of profit, that is rupees 4,000. So 30,000 plus 4,000, total balance of capital that came to 34,000. And last, liability, there is no effect. So as it is from the previous transaction, liability is carry forward, that is 8,000. Okay. So fifth transaction that we have completed. Now moving on to sixth transaction. In the sixth transaction, let us read the question. Goods of rupees 3,000 sold for 6,000 in cash. Over here also the goods that were actually the worth rupees 3,000 that were sold at a profit of rupees 3,000 and sold for cash for rupees 6,000. Okay, but this is a cash transaction. Okay, so cash will be received. So entry that would come, you can see the journal entry of the sixth transaction, that is cash account debit 6,000 to sales account credit, that is 6,000. Cash comes in, so cash will increase and stock will decrease by the amount of goods that we have sold. Okay, so now what would be the effect in the asset? Cash balance is increased. So previously the cash balance, that was 9,000. In 9,000 you will plus add, that is 6,000, because 6,000 cash you will receive. Okay, so 9,000 plus 6,000, that would come to 15,000. Stock, that was previously 9,000, in that due to sales. Now here also actual worth of stock, that is 3,000. So you will subtract from stock only rupees 3,000, not 6,000, because 6,000 at that price you have sold, but actually the worth of that stock, that is only rupees 3,000. So you will subtract from stock, that is rupees only 3,000. So 9,000 minus 3,000, now the stock value that would come to 6,000. Debtors, bank and furniture as it is. You can see debtors, bank and furniture as it is 9,000, 5,000 and 10,000. 9,000, 5,000 and 10,000. So don't forget to carry forward all the assets from the previous transactions in the consecutive transaction. Okay. Now the total of assets that comes to 45,000. How that came? That is 15,000 plus 6,000, that will come to 21,000. 21,000 plus 9, that means 30. 30 plus 5, that means 35. 35 plus 10, that means 45,000. Now due to previously the balance of capital, that was 34,000. Okay, always don't forget to carry forward the previous balance in the next transaction. So previously the balance of capital, that was 34,000. Now due to sale, the profit is earned of rupees through 3,000. So because that 3,000 will ultimately increase the capital of the firm. So capital is raised by the amount of profit, that is 3,000. So 34,000 plus 3,000, total of capital, that will come to 37,000. Then there is no effect in liability. So liability will remain as it is, that is 8,000. Okay. So up till now we have completed 6th transaction. Now moving on to 7th transaction, goods of rupees 1,000 returned to Rajesh. Previously we had purchased the goods from Rajesh, now we are returning back the goods to Rajesh, that is purchase return worth rupees 1,000. Okay, so the journal entry that will come, as you can see on the board, 7th entry, that I return Rajesh account debit. Now because we have previously purchased the goods from Rajesh, now we are returning back the goods to Rajesh. So Rajesh is the receiver of the goods. So Rajesh account debit, that is 1,000, to purchase return account credit, that is 1,000. Now due to this transaction, previously we had purchased the goods from Rajesh, now we are returning back the goods to Rajesh. So liability would be decreased by rupees 1,000. Previously we had to pay 8,000 to Rajesh, but now 1,000 has been reduced due to returning of the goods back to Rajesh. And similarly stock will be decreased because previously we had purchased the goods, so stock would have increased at that time, but now we are returning that goods back to Rajesh, so stock will decrease by rupees 1,000 for the amount of goods that we are returning. Okay, so now the effect in the assets, previously the cash balance in the last transaction, that was 15,000, stock that was 6,000. Now from that 6,000, stock is decreased by rupees 1,000 due to purchase return. We are returning the goods, so 1,000 stock will be reduced. So 6,000 minus 1,000, balance of stock, that would be 5,000. Debtors, that would be as it is 9,000. Bank balance also as it is 5,000, and furniture, that also as it is 10,000 from the previous transaction. So the total of the assets, that would be 15 plus 5, 20, 20 plus 9, that would be 29, 29 plus 5, that would be 34, and 34 plus 10, that would be 44,000. Now for capital, that would be 37,000, that was the previous balance as it is, and then afterwards in liability, previously the liability, because of that we had to pay to Rajesh, that was 8,000. Now out of that 8,000, we have returned the goods worth rupees 1,000 to Rajesh. So similarly the liability would be reduced by rupees 1,000. So 8,000 minus 1,000, now the liability would be only of rupees 7,000 to pay to Rajesh. From the effect you can identify, here the effect is written liability decrease. So here you can see 8,000 minus 1,000, liability reduction by rupees 1,000. And stock also decrease. So here you can see stock are decreased by rupees 1,000. So on the basis of the effect, you have to give the you have to do the additional subtraction in the concerned asset, capital or liabilities. Okay. And after completing of the 7th transaction, next one, that is 8th transaction. 8th transaction, that is goods of 2,000 returned by Raman. Now that is sales return. Previously we had sold the goods to Raman. Now he is returning back the goods worth rupees 2,000 to us. Okay, so sales return, it means previously we had sold the goods, so goods had gone to Raman, now he is returning back the goods to us, so goods comes in the business, so stock will be increased by that much amount. Okay, so the journal entry that will come, sales return account debit, that is 2,000, to Raman's account credit, that is 2,000, because now Raman is the giver of that goods. Previously we had sold, so he was the receiver, but now he is returning back the goods to us, so he is the giver of the goods. Okay, so because of sales return, stock will increase in the firm because that much amount of stock is coming back in the business, and receivable will be decreased. Previously due to sales, debtors was raised by rupees, previously the debtors were rupees 9,000, but from that 9,000, now we have to receive less amount, that is 2,000, because 2,000 worth of goods are returned back by the debtors, that is wrong. Okay, so the effect both would be in the assets only, stock and receivables. So previously the cash balance, that was 15,000, as per the last transaction, that is as stock that was previously 5,000. From that 5,000, sales return, due to sales return, stock has came back in the firm, so stock will be increased by rupees 2,000. So 5,000 plus 2,000, that will come to 7,000. Debtors, that was previously 9,000. Now due to sales return, the debtors will be decreased by rupees 2,000. So 9,000 minus 2,000, that will come to 7,000. Bank balance as it is, that is 5,000, and furniture also as it is, that is 10,000. Okay. So now again the total of assets that would be same, because the stock will be increased and the same amount of debtors will be decreased. So ultimately the total of assets that would remain same. Okay, that is 15 plus 7, 22, 22 plus 7, that is 29, 29 plus 5, that would be 34, and 34 plus 10, that would be 44,000. Now in case of capital also same, that is 37,000, no any change, and for liability also same, that for the previous transaction same will be for this transaction also, that is as it is 7,000. So up till now we have completed 8th transaction. 9th transaction, that is goods of rupees 1,000 destroyed by fire. Now goods that are destroyed by fire, so loss will occur to the firm, and due to goods destroyed by fire, purchase account will always be credited. So the journal entry that would come 9th transaction, that is loss due to fire, account debit, that is 1,000 as per rule of nominal account, debit on expenses and losses, to purchase account credit, that is 1,000. The effect of it that would come, capital would decrease because due to loss that much amount of capital would be reduced, and also goods will be reduced by rupees 1,000 because that much amount of stock will be reduced. Okay, so the effect of it that would be assets and capital. First of all, assets, previous balance for the transaction of cash, that was as is 15,000 when effected. Stock previously it was 7,000, in that loss due to decrease in the stock due to fire, that is 1,000, so 7,000 minus 1,000, new balance of stock, that is 6,000. Debtors, bank and furniture as is from the previous transaction, that is 7,000, 5,000 and 10,000. No any change in it. Okay. So now the total of the assets that will come to 43,000. Now that means that is 15 plus 6, 21. 21 plus 7, that will come to 28. 28 plus 5, that will come to 33, and 33 plus 10, that will come to 43,000. Now in case of capital, previous balance in the last transaction, that was 37,000. Now due to loss or due to fire, that much amount of capital has been reduced by rupees 1,000. So 37 minus 1,000, that will come to 36,000. And liability there is no any change as it is 7,000. Okay. Now after completing 9th transaction, let us read 10th transaction. Salary paid rupees 2,000. So salary is one kind of expense. So the journal entry that would come salary account debit to cash account credit by rupees 2,000. Salary is one kind of expense. So that much amount of capital will be reduced due to salary payment. So capital will be decreased and cash will also decrease because salary we are paying in cash. So that much amount of cash will go out from the firm. Okay. So one effect that would be cash, and another effect that would be capital. Okay. So cash previous balance that you can see that was 15,000. In that due to salary payment 2,000 has been reduced. So 15,000 minus 2,000, remaining balance of cash that would be 13,000. Then after stock, debtors, bank and furniture as it is from the previous transaction. Stock balance 6,000, 7,000, 5,000 and 10,000 as it is 6,000, 7,000, 5,000 and 10,000. Okay. So now the total value of the assets that would be 41,000. That is 13,000 plus 6,000, 19,000, 19,000 plus 7,000, that will be 26,000. 26,000 plus 5, that will be 31,000, and 31,000 plus 10,000, that will come to total of assets 41,000. And in case of capital previous balance that was 36,000. Now due to salary payment 2,000 balance will be reduced. So 36,000 minus 2,000, new balance of capital that would be 34,000. And liability will be as it is, that is 7,000. Okay, so we have completed 10th transaction. Now after completing the 10th transaction, let us move on with the 11th transaction. Salary outstanding is rupees 1,000. Now salary is outstanding, still the amount of salary that we have not paid. Okay, so salary is one kind of an expense. So journal entry that would come salary account debit, that is 1,000 to outstanding salary, because in future this salary we have to pay. So our liability will be increased, and liability will always be having a credit balance. So to outstanding salary account credit, that is 1,000. Now the effect that would be capital would be decreased due to payment of salary, and liability would be increased because still this amount of salary has not not been paid. So in future liability will be raised by rupees 1000. Okay. Now the effects that will be not on assets, because only in capital liability that will be effect. So as for the last transaction, the total of assets that was 41,000. So as it is, the assets total would be 41,000. In case of capital, the last transaction, the balance of capital that was 34,000. In that, due to salary payment, the capital will be reduced by rupees 1,000. So now the new balance of capital that will be 33,000. And in liability, previously it was 7,000. Now due to outstanding salary, the liability would be raised by rupees 1,000. So 7,000 plus 1,000. Total liability at the end of 11th transaction that would be 8,000. Okay. And after completing 11th transaction, let us read the 12th transaction. Commission received rupees 4,000. We have received the commission, so cash will be received. It is one kind of income for the business. So the journal entry that would be cash account debit, that is 4,000. To commission account credit, that is 4,000. Cash will be received, so cash increases, and commission is one kind of an income. So capital will also increase. Okay, so there will be effect, one in cash and another in the capital. Okay. So cash previous balance that was 13,000. In that commission cash is received, that is 4,000. So now the balance of cash that would be 17,000. Then after stock, data, spending, furniture would be as it is. So just you have to do the total of all the assets. You can see the total of assets that is coming 45,000. Okay. Previously it was 41,000. Because of commission 4,000. Now the total of assets that came to 45,000. And in case of capital, previous balance of capital that was 33,000. Now the commission is received. So due to receiving of commission income, the capital is increased by rupees 4,000. So 33,000 plus 4,000, total of capital that will come to 37,000. And no any effect in liability. So as it is, liability that would be 8,000 from the previous transaction. Now after completing 12th transaction, 13th transaction, that is receivable dividend rupees 2,000. Now this dividend is receivable. Because of any of the shares. On the shares we are receiving the dividend, but still this dividend is not received. It is to be receivable. It means it is outstanding income. Okay. So the journal entry that will be receivable dividend account debit, that is 2,000, because in future that amount will be received. So our income will be raised by rupees 2,000, and to dividend account credit, that is 2,000. Due to that dividend income, our capital will be increased. So you can see the effect, that is receivable is increased by rupees 2,000, and on the other hand, capital will also increase due to dividend income by rupees 2,000. Now one effect, that is receivable increased. So you can see all the other assets as it is I have written from the previous transaction, that is cash value as it is 17,000, stock that is 6,000, dealers that is 7,000, bank 5,000, and furniture that is 10,000. Only one new asset that has been introduced or increased, that is receivable dividend, that is rupees 2,000. So now the total value of assets would come to 47,000. So previously the value of assets, balance of assets, that was 45,000 plus receivable dividend, that is 2,000. So now the total value or the balance of assets that is coming to 47,000. Now in case of capital, previous balance that was 37,000. In that, dividend is one kind of income, so our capital would increase by rupees 2,000 because of income. So 37,000 plus 2,000, total balance of capital that will come to 39,000, and no any change in liability. So liability would remain as it is, that is 8,000. So students, till now we have completed 13th transaction. Now we want to 14th transaction. Insurance premium of shop paid rupees 500. It means insurance premium is one kind of expense, and that is paid of shop, that is rupees 500. So cash goes out because of expense. Okay. So the journal entry that would come, that is insurance premium account debit, that is 500, to cash account credit, that is 500. Now due to insurance premium, the expense cash would be paid. So capital would be decreased by that much amount of expense, and due to expense paid in cash, so cash balance would also decrease. Okay. So one effect that would be in cash, that is in assets, and another effect that would be in capital. Okay. So you can see previous balance of cash that was 17,000 minus insurance premium that is paid, that is 500. So now the cash balance that is reduced to 16,500. Stock, outstanding dividend, interest, bank, and furniture, that is as it is from the previous transaction. So now the new balance of the assets that will come to 46,500. Previously it was 47,000. Now it is reduced by 500. So the new balance that came to 46,500. In case of capital, the balance from the previous transaction that came to 39,000. In 39,000, insurance premium is paid. So that much amount of capital would be reduced by rupees 500. So now the new balance of capital, that is 38,500. And in case of liability, that is as 8,000. Now moving on to 15th transaction. In case of 15th transaction, computer of 8,000 is purchased from Sri Krishna Computer Company. A computer is purchased from Sri Krishna Computer Company, and it is a credit transaction because cash is not paid over here. So here you can see the transaction that I have written journal entry, that is computer account debit, that is 8,000, to Sri Krishna Computer account credit, that is 8,000. Now assets to increase because computer is one kind of assets. So with the effect that would be assets increase and liability would be increased because we have not paid the amount to Krishna. So in future Krishna Computer Company, we have to pay that much amount to that company from which we had purchased the computer. So liability will be increased by rupees 8,000. So the effect, one effect that would be assets would increase. You can see all the other assets I have written as it is from the previous transaction, and just I have added computer, that is 8,000. So the new value or the new balance of assets that will come to 54,500. And in case of capital, that would be as it is, that is 38,500 from the previous transaction, as it is same balance. And in case of liability, previous balance of liability, that was 8,000. Now new liability is raised because now we have to pay 8,000 rupees to Krishna Computer Company. So liability will be increased by rupees 8,000. So 8,000 plus 8,000. So now the balance of liability that will be coming to 16,000. Okay, so students, we have completed up till 15th transaction. Moving on to 16th transaction. Let us read the transaction. Owner withdraw rupees 1,000 from business. It means it is for personal use. That means drawings would come over here. So you can see the journal entry that I have written 16th transaction, drawings account debit, that is 1,000, to cash account credit, that is 1,000. Due to drawings, that much amount of capital will be reduced and cash will also decrease because that much amount of cash goes out from the firm. So the effect that would be one in capital and another cash balance would decrease, that is in assets. So here you can see stock as it is, I have written 6,000, outstanding dividend that was from the last transaction as it is 2,000, cash balance that was 16,500 minus drawings, that is 1,000. So now the balance of cash, that is 15,500, debtors, that is 7,000, bank, that is as it is 5,000, furniture, that is 10,000, computer, that is 8,000 as it is from the last transaction. So now the total of the balance of assets that came to 53,500. Okay. And afterwards, in case of capital, previous balance as for the last transaction, that was 38,500 minus drawings. Because of drawings, the capital balance has been reduced by 1,000. So now the new balance of capital, that is 37,500. And in case of liability, as it is, that is 16,000. Now the next transaction, that is 17th transaction, account settled of Rajesh. Now from Rajesh, we had purchased the goods. Now we are paying the remaining amount. Out of that amount, whatever we had purchased the goods, we had returned certain amount of goods to Rajesh back. So purchase return amount that we had done, and remaining amount, now we are settling that amount. It means we are paying that amount which is outstanding to Rajesh. So the journal entry that would come, Rajesh is the receiver of that account. So Rajesh account debit, that is 7,000. Out of total 8,000, we had returned goods worth rupees 1,000. So remaining balance that we have to pay, that is only 7,000. To cash account credit, that is 7,000. So now liability would be decreased because previously liability was raised of 7,000. Now out of that 7,000, we are paying the entire amount, that is 7,000. So by liability would be decreased by rupees 7,000, and cash will also decrease because we are making that payment in cash. So cash will go out from the firm. So two effect would be there. One would be liability and another in the cash balance, that is in assets. Okay. So total balance of the assets, that was 53,500. From that, cash balance will be reduced by rupees 7,000. Students, I have not shown all the assets over here. Just I have shown the decrease in the cash balance, that is by rupees 7,000. So now the new balance of assets that will come to 46,500. In case of capital, there will be no any change as it is the same balance, 37,500. And in case of liability, the previous balance that was 16,000. Now the liability will be decreased by rupees 7,000 because now 7,000 we are paying to Rajesh. So 7,000 liability will be reduced. So now the balance of liability will be only rupees 9,000. The last transaction, that is 18th transaction, account settled by Raman. Previously we had sold the goods to Raman, so outstanding amount was there we had to receive from Raman. Raman was the debtor of the firm. Now he is settling that amount to us. He is paying that amount to us. So previously, after doing the sales return, there was total 9,000 worth of transaction of Raman. Out of that 9,000 worth of goods, 2,000 worth of goods that were returned back by Raman. So remaining balance that was only rupees 7,000. Now that 7,000 Raman is paying to the business, to the firm. So our bank account, so we will receive that much amount of cash. So cash balance will be increased by rupees 7,000. So the journal entry that will come cash account debit, that is 7,000, to Raman's account credit, that is 7,000, because Raman is the giver of that amount. Okay, that is Raman is the giver, so credit the giver. Now because of this transaction, cash will be increased because that much amount of cash comes in the firm, and receivable would decrease. Previously we had to receive that much amount from Raman. Now that receivable has been paid by Raman, so receivable would be decreased by rupees 7,000. So you can see both the effect that would be in the assets only. That is, previously the cash balance that was 8,500. From that 8,500, Raman has we had received the amount from Raman, that is 7,000. So now the new cash balance that would be 15,500. Stock would be as it is from the last balance, that is 6,000, as it is 6,000. Outstanding dividend also 2,000 as it is. Debtors previously that were 7,000. From that 7,000 we have received that amount of debtors, that is 7,000. So now the balance of debtors that would be nil. Okay, and because of lack of space I have written over here, that is bank balance, that is as it is 5,000, furniture also as it is 10,000, and computer as it is 8,000. As you can see the previous transaction, that is bank, furniture and computer, same balance I have written over here, that is 5,000, 10,000 and 8,000. After adding in cash and decreasing the debtors, the new balance or the final balance of assets that came to 46,500. And in case of capital, the balance would remain as it is, no any change, that is 37,500. And in case of liability also there is no any change, as it is the liability from the previous transaction balance would be only 9,000. So now you can verify as per the equation. What equation I told you? Assets is equal to capital plus liabilities. So here you can see what came the total of assets, that is 46,500. What is the total of capital, that is 37,500. And what is the total of liability, that is 9,000. Okay. So assets is equal to capital plus liability. Now capital plus liability means 37,500 plus 9,000. You will do the total of this two. You will get 46,500. It means our calculation as per the equation, that is correct. It means always the value of assets will be equal to the total of capital and liabilities. So in this way you have to calculate the entire sum. You have to carry forward the assets, capital and liability from the previous transactions, and accordingly at the last you have to find the total of assets, capital and liabilities. And always the total of assets will be equal to the total of capital and liabilities. So this would give a proof that your answer is correct. So that's the end of the video lecture today, students. In the next video lecture I will be explaining you one practical sum from exercise, and that will be the last and final sum of this chapter. Till then, goodbye, keep practicing, stay blessed.